This is a very basic accounting course, but will act as the foundation of your advanced accounting studies. As this course is meant for the beginners, I've tried to be as simple as I could and avoided the use of technical language. My purpose is to make you understand the concepts of accounting rather than preparing you for an exam. Alright, so in this video, I will be covering how to write journal entries, how to write ledger accounts or T accounts, how to prepare trial balance, and how to prepare profit and loss account and balance sheet. Before we discuss anything else, I would like to briefly touch upon what is accounting and need for accounting. I'm going to explain this through a small real-life example. Suppose you plan a car trip with a bunch of friends. Being the group leader, you take the responsibility of managing the finances of your trip. You decide on a budget of Rs 15,000 per head. Now, during the trip, you make a lot of transactions. You spend on hotel, you spend on food, you spend on sightseeing, you lend some money to your friend, you borrow some money from your friends, and you incur various other expenses. Now, when you are back from your trip, you realize that you have overspent and the per head budget exceeds the budget fixed before the trip. Now, this makes all your friends very unhappy. You are totally confused and have no idea where all the money has gone. You are not able to account for the extra spent to your friends. So what went wrong here? All this could be avoided if you had maintained a proper account for your money. Friends, this was just an example, but in business world, numerous money transactions take place every single day. Imagine, if no records are maintained for such transactions, then what would happen? Also, do you think that records for such numerous transactions can be maintained on a piece of paper? Probably not. This is why such financial transactions are written in accounting language to give a clear view of the finances. So, we can say that accounting is an art of recording the financial transactions. The transactions are recorded in an accounting book called journal, which we will discuss later. Then we can further say that accounting is an art of classifying transactions of similar nature under one head. For example, all cash transactions can be classified under cash account, which will show a clear picture of the movement of the cash in the business. Finally, accounting is also an art of presenting the financial information to its stakeholders. Imagine, in my car trip example, if all the expenses were clearly presented to your friends, then it would have brought transparency, and everyone would have got a fair understanding of where the extra money spent has gone. Similarly, in the business world also, accounting helps in presenting information to its stakeholders, such as shareholders, creditors, CEOs. Accounting helps them to know the reason for variance in profits. So let's discuss the process of accounting. Accounting begins with writing the journal entries and ends with preparing the balance sheet. So let's discuss the complete process. Friends, every time a financial transaction is made, it is recorded in an accounting book called journal. Transactions are recorded in this book in the form of journal entries. In earlier times, journal used to be a physical book where the entries were made manually by hands. However, in today's time, everything is done through various accounting softwares. So the next step in accounting is to prepare ledger accounts. Ledger is again an accounting book where various accounts are created, such as cash account, stock account, machine account, etc. There can be hundreds of accounts depending upon how big the business is. The purpose of writing ledger account is to classify transactions involving similar items at one place. This will help the business to know the value of a particular item at the end of the accounting period. For example, cash account will let the business know how much cash did the business start with and how much is the cash balance at the end of the accounting period. Next step is to prepare trial balance. The purpose of trial balance is to detect any mathematical or fundamental error in the ledger accounts. In accounting, debits are always equal to credit. I will explain this later why. The trial balance actually compares the closing balance of debits with the closing balance of credits. If both debit side balance and credit side balance are equal, then the ledger accounts have been prepared correctly. Though there are still chances that there may be some error, but I won't go into that much detail right now. So, if the debit balance and credit balance are not equal, then that shows there is an error while preparing the ledger account, which means some amount is not recorded or incorrectly recorded in the ledger accounts. We will discuss more about ledger accounts in the coming slides. Finally, we prepare profit and loss account and balance sheet. These two accounts are also called final accounts. Profit and loss account shows the net profit or loss to the business for a specific period, and balance sheet shows the position of the assets and liabilities of a business at a given point in time. Well, Newton's third law says for every action there is equal and opposite reaction. Similarly, in accounting also, for every transaction there is an equal impact on at least two or more accounts. This means if you debit some amount in an account, there would be an equal credit of the amount in another account or accounts. Let's better understand this. Whenever we record any transaction in the journal in form of journal entries, we debit at least one account and credit at least one account. There can be more than one debit or credit as well, but at least one account must be debited and credited. This is called the double entry system. According to the system, every financial transaction impacts at least two accounts, one of which will be debited and another will be credited. Now, observe the example given on the slide carefully. XYZ company purchases office furniture for Rs 80,000. So, do you think XYZ company has only purchased office furniture and there is no other impact on the business? If we read the example again, we will find that XYZ company is purchasing the office furniture and at the same time paying money or cash of Rs 80,000 to buy that furniture. So, we can say the furniture is coming in the business and cash is going out of the business. If we were to identify two accounts involved in this transaction, then those accounts would be furniture account and cash account. Business can give whatever name to the accounts. We may call furniture account instead of office furniture account, or we may give any other name to the cash account. So it is up to the business to name its account. Now look at the example number 2. XYZ company purchases office furniture worth Rs 80,000 on credit from Messrs. Best Furnitures. Here, the business is purchasing office furniture but not on cash. Business is buying it on credit. So now, what two accounts are impacted here? First one would be office furniture account, and the second one would be creditors account. Since business has brought furniture on credit, it has created creditors for its business, to whom the business will have to pay off the money in future. We will learn about which account to debit and which account to credit in the. Now, every financial transaction can be classified under 5 major types of accounts. These are assets, liabilities, expenses or loss, income or gain, and debtors or creditors. Can you think of any other category? No, right. So, every financial transaction would either impact an asset account, or a liability account, or an expense account, or an income account, or debtors or creditors account. Now, what is an asset? Asset is something that gives the business some immediate benefit or benefit in future over a series of years. For example, car, if used for business purposes, is a benefit to business. So, car is an asset for the business. Similarly, building, which is used for operating the business, is a benefit to the business. Hence, it is an asset too. Plant and machinery helps business in production of materials. It is an asset. Similarly, cash, long-term investments, short-term investments, or any other thing that gives business any benefit, whether in present or in future, is an asset for the business. Coming on to liabilities. Anything which business owes to others is a liability. If a business has taken a bank loan, it owes this amount to the bank. Hence, this is a liability. Also, the interest to be paid on the loan is also a liability. Salary to be paid to the staff every month is a liability for the business. In fact, any money given to the business by its owner is also a liability, because in accounting, business and its owners are two separate entities. If owner invests some money in his business, it will be a liability for a business, as business is required to return that money to its owner. Now, revenue, income or profit. Revenue or income means any proceeds received from sale of goods or from rendering of services by business. Profit means any gain made from the business activities. For example, business sell a product of Rs 100 for Rs 150. We can say that business has made a profit of Rs 50, right? Now, what is an expense or loss? Expense means the cost incurred by the business to earn revenue or profit. For example, business pays salary to the staff to compensate the staff who works for the business and helps business earn revenue or profit. Similarly, a business spends money in purchasing goods for selling further at profit. Here, the amount spent on purchased goods is an expense. Now, what is a loss? A loss is a decrease in net income of the business that is outside the normal operations of the business. For example, goods destroyed due to fire is a loss for business. Similarly, an asset is sold at less than its original value is a loss. Amount a business is required to pay as a result of a lawsuit against the business is also a loss. Coming on to debtors. Debtors are the persons or entities who owe money to the business. That is, they are required to pay some money to the business. For example, the business sells goods to Mr. X on credit. Then Mr. X will become debtor of the company. as Mr. X now owes money to the business and he is required to pay that money to the business at a future date. Debtors are also classified as an asset in the balance sheet because debtors are required to pay money to the business in future, and this will be a benefit for the business. Coming on to creditors. Creditors are the persons or entities to whom business owes the money. That is, business is required to pay these money to these persons or entities. For example, business buy goods from Mr. X on credit. Here the company has not yet paid for the goods to Mr. X, but taken a credit. So Mr. X will become a creditor of the business. Creditors are classified as liability in the balance sheet because the business owes money to the creditors. What is capital? Capital is nothing but the amount invested by the owner in the business. For example, Mr. X is the owner of XYZ business. Mr. X invests rupees 50,000 in XYZ business. Then this 50,000 rupees is called capital. Since capital is the amount given by the owner to its business owes this amount to its owner. Hence, it is treated as a liability in the balance sheet. Alright, so on this slide we can see various accounts that fall under these major categories. For assets, we can see that cash is an asset. Short-term investments are assets. Accounts receivable. Account receivable means the money which business is yet to receive, which they have not yet been paid, but they will be receiving this in future. Accrued revenues receivables. Prepaid expenses. Prepaid expenses means any liability that has been any expense that has been paid before it is due. Suppose you pay insurance premium before it is due, so it will be an asset because you have paid off a liability in advance. So it's a benefit to the business. Inventory means stock of goods. Supplies, long-term investments, land, buildings, equipment, vehicles, furniture and fixtures, all these provide benefit to the business. So these are classified under the category of assets. Now coming on to liabilities. Notes payable, accounts payable, salary payable, wages payable. Here the business is required to pay this money to others. Business owes money to the other person. So this is a liability for the business. Similarly, income or revenue, service revenue, that means revenue earned from the services. Sales, you make sales and you earn money from sales. That is also your income, your revenue. Rent income, company leases some building and receives rent. It's an income. Interest income, any interest on say fixed deposit is an income for the business. Royalty income, commission income, these all are income for the business. Expenses. So there are various expenses like supplies expenses, salary expenses, depreciation expense, insurance expense, fuel expense, rent expense. These are the expenses that business has to incur to run its business, to earn revenue. So these are all classified under the expense category. Please note that this is not an exhaustive list. This is just a list of general accounts that are generally used in the businesses. So there can be more different categories of accounts under assets, different categories of accounts under expenses, under liabilities, under income revenue.